Good morning, everyone. Good morning, Nidhi. Good morning, Soham, if you're around. Good morning, Srishti. Good morning, Kaushiki. Good morning, everyone. So we commence our discussion on Ind AS 103 again, third session today. So in the previous class, we had seen these four items of payment. One is cash paid. The second one is fair value of shares, debentures, other securities, which is paid as PC. The third one is fair value of assets other than cash transferred. We saw the adjustment that needs to be done. And finally, we have present value of deferred consideration, which also we have already seen. Okay. So now we move on to the next part, that is an important element of purchase consideration. You can give it as note 3. We have discussed in detail about deferred consideration. In deferred consideration, the important thing is that you will not have any future event that is going to happen. It is for certain that you are going to pay the consideration. Only thing is there is going to be a postponement of such payment. That is a deferment of the consideration. So that is important because many students may get confused between contingent consideration, which we are now going to discuss, vis-a-vis the deferred consideration. Okay. So note number 3, you can write. I hope we wrote this example also on deferred consideration. Okay. So note number 3, you can give the heading contingent consideration. You can give the heading as contingent consideration. Okay. Now, what is the meaning of contingent consideration? Now just pay attention. Okay. We'll write some notes, but right now I'll just explain to you with the help of an example. And later on we can take we can make notes and complete the concept. Okay. So now this is a recent, what you can say, recent development, because we are having so many startups, so many companies coming up, acquisitions keep on happening on a regular basis. So it is a fairly relatively new concept. We did not have these kind of concepts when we studied AS 21 or AS 14. So what is the meaning of contingent? Well, it's dependent on some future event that is going to happen. So that means you are going to pay the purchase consideration in the future, but that payment is linked to some particular event. That consideration which you will pay is linked to some particular event. If that event is satisfied, if that event is completed, then the contingent consideration becomes payable. If that event does not happen, then contingent consideration is not payable. So let us take an example. L&T acquired Mindtree. Okay. L&T acquired Mindtree. Okay. Now this is just a story for you guys to understand. Now when L&T acquires Mindtree, it would have acquired it with the what you can say, with the intent that both the companies can grow. That means there is going to be a synergy in terms of performance. There is going to be a synergy in terms of revenue increase. There will be a synergy in terms of cost savings. There could be a synergy in terms of increased profitability. So when L&T acquires Mindtree, let us suppose that in the purchase contract that is there, okay, the shareholders agreement, L&T will have this particular clause inserted in that shareholders agreement. Okay. If turnover of Mindtree, case 1, exceeds, is less than or equal to 250 crores post acquisition. Okay. This is post acquisition turnover of Mindtree. If this is less than or equal to 250 crores, that means up to 250 crores, in turnover of Mindtree post acquisition. Kitna time? First 3 years. Okay. Within the first 3 years, if this is up to 250 crores, consideration payable would be 0. That means L&T is of the belief that 250 crore tak to Mindtree has to achieve regardless of whether it is acquired by us or not, and therefore no consideration will be payable in the future. Presently, for some shares which are transferred, there will be a consideration that will be paid. Okay, so this is like additional consideration. Don't think that kuch bhi nahi hoga aise kaise, nahi. There will be some PC which is already discharged now, but there is some consideration in the future which will be discharged based on this turnover condition. Okay. Second, if it exceeds 250 crores, okay, if it exceeds 250 crores, turnover exceeds 250 crores, but is less than 500 crores. If this is the case, then L&T will pay additionally 10 crores as purchase consideration. If this is achieved within the first 3 years, so whenever it gets achieved, that time this trigger of rupees 10 crores will be hit. Okay, that time this 10 crore payment will be triggered. L&T has to make a payment of 10 crores, not to Mindtree, but to the owners of Mindtree. Third case, suppose your turnover exceeds 500 crores up to 1000 crores. If this is the case, then 25 crores payment will be made. If this is the case, then 25 crores payment will be made. And this is how the agreement is structured. Fourth case, if your turnover exceeds 1000 crores, okay, if it exceeds 1000 crores, then rupees 45 crores will be payable. So this is how you have your deal that is structured. Now I want you to understand and tell me, is it same like deferred consideration or is it different from deferred consideration? Deferred consideration in our example, 1331 would be payable after a period of 3 years. Whereas here also it is payable in the future depending on what is your turnover. This is extra consideration. Okay, don't think that this is the only consideration. This could be some additional consideration. What I want you to tell me is there any difference between the deferred consideration that we saw on top? Is there any difference with the contingent consideration that we are now seeing? Come on, tell me. Is there any difference, or do you think it is basically the same? Is there any difference, or do you think it's essentially the same? Come on, I need your answers, guys. Yes. Why is it different? Why do you think it is different? Sumit Jain is saying it is basically the same. Any other answers? Srishti Goyal, Rashmi Kamath. What do you guys think? Is it the same or is it different? No answers flowing. See, under deferred consideration, there was no doubt about payment. आपका turnover zero भी हो सकता है. You can have a zero turnover. In spite of that, you would end up paying 331 rupees extra. in the future. You would end up paying 331 rupees extra. Sir, why are you paying? So is there a certainty in deferred consideration? Yes. It is certain. You are absolutely sure that you are going to pay 1,331 rupees in the future, the present value of which is 1,000, and therefore that 331 extra which you are paying, it was only on account of time value. It was only on account of time that is given to you to make the payment. Okay, so you discount it to the present value and so on and so forth. You did the accounting. So is there any uncertainty in deferred consideration? Answer is no, there is no uncertainty. The outflow is guaranteed. But in the second case, that is of contingent consideration, today when I acquire the company, do I know what will be its turnover within the first 3 years? Do I know that for sure? Sir, no, I do not know that. And because I do not know that, can it be the same like deferred consideration? No, it cannot. Deferred consideration, aaj baithe baithe, I know that I have to pay 1,331 in the future. But in the case of contingent consideration, sitting today, I don't know whether I have to pay 10 crore, 25 crore, 45 crore, or whether I don't have to pay anything in the form of additional consideration. So it is basically two very different things. It is basically two very different things which we are discussing here. Okay. In one case, it's totally dependent upon only passage of time. And is passage of time a certainty or an uncertainty? It is a certainty. 3 साल definitely बीतेगा. Okay, 3 years will definitely pass, and therefore it would be a certainty. Whereas in the case of contingent consideration, I do not know my turnover. I do not know my turnover, and therefore this is quite different from that of deferred consideration. So how do we proceed to record this? How do we proceed to record this? Dekho, one thing you have to understand. There is a hanging sword on the acquirer's head. Hanging sword means जैसे ही trigger the turnover crosses 250 crores, the payment starts becoming due. The payment starts becoming due. So that means you want the entity to exceed the turnover. You want the entity to exceed. It is like an incentive which you are going to give. The fact that this was a part of purchase consideration indicates that even the shareholders of the target company are expecting this consideration in the future. So in other words, when you are acquiring on the date of acquisition, you basically have a purchase consideration which is being discharged on the date of acquisition, and you have a liability. Although it is a contingent one, you have a liability that is going to be recorded on the date of acquisition itself in the form of contingent consideration payable. Till now, you have only seen, or you have only understood that contingent liabilities should not be recorded in the books of accounts. Contingent liabilities should go in as a disclosure below the financial statements. However, in this case, and this is the first time you are going to hear, though it is a contingent liability dependent on a future event that is not directly in control of the reporting entity. So even though this is what is going to be your event, which is not in your control, you will still record the contingent liability. You will still record the contingent liability. Sir, how do we record? मेरे को तो अमाउंट मालूम नहीं है. I don't know whether I have to take it as 0, 10, 25, 45. I do not know. So here the standard comes to your rescue and tells us you will not record the consideration at these amounts. You will not record the consideration at these amounts. Okay. You will instead, one second, please. Just a minute. I lost connection of the pencil. Fine. अब ये कहाँ से आ गया? Things keep happening. Just give me a minute. Where did this come? Okay. All right. So will I be recording it at this amount? The standard says no, you cannot, because I do not know what I am going to pay. So the standard tells you will record it at fair value. Sir, what do you mean by fair value? It is a future looking value. It is a future looking value. We saw this in one of the Ind ASs, okay, Ind AS 102 when we did. We saw that the transaction, the ESOP is being recorded at a fair value, which is a future looking value. So how am I going to record this? This will be valued. The fair value of this consideration will be calculated. So how will you calculate, sir? Well, for example, a very basic thing, you can estimate the probability of these conditions being met. So for instance, this is your purchase consideration 0, 10, 25, 45. Suppose the probability that you will meet the turnover criteria, just suppose it is going to be this is less than, okay, this is nil. So let us assume that your turnover up to 250 crores, the chance is 30% you will not cross 250 crores. Let us assume that the turnover between 250 to 500, there is a 20% chance that you will be meeting it. 500 to 1000 crores, there is a chance that there is a, let us assume a 25% chance that you are going to meet it. And then 30 plus 20 plus 25, so this is 3 to 5 to 7, there is another 25% chance that you will be crossing 1000 crores. So now what you do, you just multiply weighted average. Okay, so this is 0, this is 25 into 25%. This is 6.25 and 45 into 0.25. So that gives you how much? 11.25. Okay, so 11.25, 6.25. This gives you 19.5. But the turnover is the first 3-year period. Okay, so within 3 years, if you meet this, so therefore, let us assume that the payment will happen after 3 years. You will discount it to present value. You will discount it to present value. 19.5 divided by, assuming discount rate to be 10%. This is going to be 19.5 divided by, 19.5 divided by 1.331. So this gives you a fair value today of 14.65 crores. And this is what you are going to record in your financial statements on the date of acquisition. Acha, in exam, do I have to calculate fair value? Answer is no, you do not have to calculate fair value. This value will almost always be given to you, You just have to give the accounting impact of this value that you are going to pay, Okay, sir, but with the passage of each year, the circumstances might change. Definitely they can. For instance, we had a black swan event in the form of COVID-19, when all these cases are going to change drastically. So do I have to factor that in? Yes, you have to factor that in your calculations. Okay, so far have you guys understood contingent consideration? Yes, so far have you guys understood contingent consideration? This is a consideration which is payable in the future depending on the occurrence of certain events which is not in control of the reporting entity, which happens to be the acquirer. And since it is not in control, I cannot really identify what will be the exact amount payable. So the standard tells, in your purchase consideration, you will add the fair value of the contingent consideration that you are going to that you are expecting to pay in the future, that you are expecting to pay in the future. In the case of deferred consideration, you are not adding fair value, you are adding present value of the consideration which you will pay in the future. Okay, so this is the first step. This is the first step. Date of acquisition, fair value kitna hai, record it. That is going to be your contingent consideration payable. That is going to be your contingent consideration payable. All right. Now, okay, we'll just write this down. Okay, we'll just write this down and then let us proceed with the discussion. Okay, so give the heading note 3 contingent consideration. We'll write a small note for this and then continue the discussion. Okay. It refers to an additional obligation, on the acquirer to pay the owners of the target. It refers to an additional obligation to pay the owners of the target based on occurrence of certain future events. Based on occurrence of certain future events. Contingent consideration should form part of PC on the date of acquisition. Should form part of PC on the date of acquisition with the same being recorded at fair value. With the same being recorded at fair value. Generally, fair value information would be given in the question. Would be given in the question. If not given, comma, probability based weighted average value adjusted for time value of money can be considered. Okay, तो ये हो गया मेरा basic concept on contingent consideration. I'll come to that, Srishti. I'll come to that. Okay, I'll come to that. Have you guys written? Yes. Kaushiki is not there today. Soham is not there today. How many are? Done? Okay, fine. All right. So come to the place where we had left about half a page for PC and write here, add fair value of contingent consideration. Note 3. Note 3. Okay, fair value of contingent consideration. Okay. All right. Fine. Okay, so I hope you have written that also. And now let us come to subsequent discussion on contingent consideration. Sir, I have determined the fair value on the date of acquisition. But sir, my fair value is dependent on the occurrence of certain future events. Sir, the certainty of future events also can change. Yes, it can change. For example, you expect that the turnover crosses 1000 crores and you will record 45 crore as the value adjusted for time value of money. But in the second year, you come to know that it will not cross 1000 crore. It will be somewhere in the range of 250 to 500 crore. So there is a change in your estimate. There is a change in your estimate. Sir, do I have to give effect for this estimate? Definitely you have to give effect for this estimate. Why? Otherwise, what will happen is your contingent consideration payable will appear at a higher value than what is actually going to be paid. So what the standard tells is, the moment you record contingent consideration payable, you have to have a clarity. On the date of acquisition, the accounting is in accordance with Ind AS 103. What 103 told? Fair value nikalo, account kar do. So we are accounting it in the as a part of PC. After that, Ind AS 109 takes over. After that, Ind AS 109 takes over. What 109 asks us? It asks us, look, this is a contingent consideration payable. So the first question that it asks is it payable in cash? Is it payable in cash? Yes. If it is payable in cash, then it becomes a financial liability. And because it is a financial liability, we will have to measure the fair value of that every reporting date. Measure the fair value at every reporting date, and any change in the fair value will be given effect through the profit and loss account. You will be applying the fair value through P&L model. You will be applying the FVTPL model. Is it okay? Yes. So subsequent accounting depends on first one, whether it is a financial liability, that is an obligation to deliver cash. If it is, every reporting date, measure the fair value. So when you are measuring the fair value, obviously you will, at the end of each reporting date, you will obviously ask the question, sir, whether I have met the consideration, whether I will meet the consideration in the future or not. That is the questions that each one of us will be asking when we are determining the fair value in the future. So based on the facts that have come into light in the second year, obviously my fair value will undergo a change. And because it is having a fair value change that is happening, you will have to take the change in fair value to your profit and loss account. You will have to take the fair value to your profit and loss account. Is it okay? Yes. So that is how you will have to do it. Okay. All right. Sir, contingent consideration will always be paid in cash? Not necessary. Entity will say, if you meet this, I'm going to give you my equity share. So can it be settled in equity shares of the acquirer? Answer is yes, it can. So if it is going to be settled in equity shares of the acquirer, then the question arises, will it be a financial liability or will it be equity? Will it be a financial liability or will it be an equity? Answer is, it depends on how the payments are structured. If it is a fixed number of equity shares at a fixed price that is being settled for the contingent consideration that is due, then such transaction will be in the nature of an equity, and that would not be remeasured because own equity, we do not remeasure in the financial statements. Whereas if it is a variable number of equity shares, you would have studied in your financial instruments chapter fixed to fixed conversion or fixed or variable conversions. Okay, fixed to fixed conversion, you have a bond, the bond is convertible into a fixed number of equity shares at a fixed value, then that becomes an equity transaction. That bond, I mean, it could be classified as equity. Okay, that bond could be classified as an equity if it is a compulsorily convertible bond converted into fixed number of equity shares at a fixed value. However, if that bond is convertible into a variable number of equity shares at variable values, then in that case, it does not pass the fixed for fixed test, and therefore the bond would be classified as a financial liability. This was what we have learned from Ind AS 109. The same principles are brought here. The same principles are brought here. If the contingent consideration is going to be settled in equity, answer the question, is it fixed for fixed? If yes, equity, no subsequent remeasurement. No subsequent remeasurement. If no, it is a variable, then in that case, it will be a financial liability. You will have to follow FVTPL principles. You have to follow FVTPL principles. Are, have you understood? Have you guys understood? Yes. Okay. Soham, good. All right. Have you guys understood? Yes. You can write as a continuation here. Subsequent to date of acquisition, accounting for contingent consideration would be based as per Ind AS 109 principles. Okay, would be based as per Ind AS 109 principles. Okay. Nidhi, Sumit, Aniket Jain, Shailendra, these were the students who were attending in. Are you guys there, able to understand? Yes. So just note this small sentence and then we'll just prepare a chart for contingent consideration. Okay. I hope you would have noted this down. So contingent consideration. Initial recognition as per Ind AS 103. As per Ind AS 103. Subsequent recognition. This is going to be using 109 principles. Okay. What initial recognition tells us? Measure contingent consideration at fair value. At fair value. Irrespective of whether payable in cash or shares, and regardless of probability. Okay. So where will this go? This will be part of purchase consideration. This will be part of purchase consideration. It's going and sitting there in my PC working, which you have prepared. Okay. Whereas subsequent recognition, you will have to answer the question, ki bhai, how are you going to settle it? How are you going to settle it? So the question that you will ask is, obligation to pay cash. If yes, this will be a financial liability, or it could be settlement in entities, own equity instruments, own equity instruments. If this is the case, you will again answer the questions as to whether it is a variable number of equity shares or if it is a fixed number, fixed for fixed. If this is fixed, then this goes under equity. No subsequent remeasurement. No subsequent remeasurement. However, if this is a case, both this and this are not equity items. This is a financial liability. Will you remeasure? Yes, of course you will. It will be remeasured, and the difference in fair values on account of remeasurement will be taken to the profit and loss. Will be taken to the profit and loss. Okay, have you noted this? Done? Okay, fine. All right. So now let us move on. We'll just solve a small, I'll just give a small question so that you can see how the accounting happens. Okay. This is example. Okay. In your institute's problems, the issue is they do not give obviously one concept at a time in the problems. Okay. You will be having 2-3 concepts put together. Okay. So we'll take small examples one at a time. And then when we understand all the aspects, we can pick up the institute questions. Okay. P acquires S, both are companies. Okay. For immediate cash payment of ₹100 and a contingent payment based on turnover of S after 3 years to be paid in cash. The fair value of such contingent consideration is as under year 0, 1, 2, 3. Fair value 58, 102, 80, 40. Net assets of S on date of acquisition are rupees 140. Show the account. Sorry, 1 second, 1 minute, 1 minute. This will be 80. This will be 160. Yeah. Have you noted the question? Okay, so now let us move on. Solution. Initially means this is on the date of acquisition, obviously. Okay, so when you will have to record, the entry will be net assets of S debit to bank to contingent consideration payable. How much are you paying immediately? 100. Contingent consideration, you are expecting it to be 58. Net assets that you have acquired is 140. So that gives you how much? 18 as goodwill. This is goodwill. Essentially, these two become your purchase consideration. These two together, 100 plus 58, become your purchase consideration. Okay. Have you understood the first entry? Have you understood the first entry on the date of acquisition? Year 0. That is date of acquisition. Okay, next one. Year 1. Okay, has the value changed? Has the value changed? Yes. Has the value changed? Very much yes. It has become from 58, it has become 102. From 58, it has become 102. So there is an increase. Increase of how much? 102 minus 58. That gives you, I guess, 44. That gives you 44. So this is increasing the liability. It will be a loss. This loss will be taken to the P&L. So fair value loss. P&L debit to contingent consideration payable. 44, 44. fair value loss P&L debit 44 to contingent consideration payable 44. This is essentially 102 minus 58. 102 minus 58. Okay. Year 2 consideration is 80. Okay. It was 102 in year 1. Year 2 it became 80. So we reverse to that extent. Year 2 contingent consideration payable debit to fair value gain, which goes to the P&L. Okay, this is going to be 180 minus 102. So this is 22. This is 22. Year 3, the value is 160. 160. Fair value loss debit to contingent consideration payable. 160 minus 80. So this gives you 80 and 80. Loss. Okay. Done. And then year 3, you will discharge it. You will pay it off. So contingent consideration payable debit to bank 160. 160. Are, have you understood? Have you understood? All clear. Acha. Now, suppose this contingent consideration of 160 would not have been payable, Okay. If that is the case, then the fair value at the end of year 3 would be 0. And ultimately that 160 would be taken to the P&L, would be taken to the P&L. Okay. Contingency did not arise at end of year 3, comma, fair value at the end of year 3 would be nil. And not 160. And in such case, comma, entry in year 3 would be contingent consideration payable debit to fair value gain. P&L. How much would that be? Well, that would be 80, 80. Yes. All right. Acha. Last question. Suppose this had to be equity. this had to be equity. तो remeasurement तो नहीं होगा. It would appear at this value right from the beginning. It would appear at this value right from the beginning, 58. Now suppose the contingency is not met. What do you think will be done? What do you think will be done? Okay. The contingency is not met. You do have no obligation to settle that amount. So what are you going to do? Bolo, did you understand the question? Bolo, suppose ये liability नहीं होता, this would be in the nature of equity, fixed for fixed. Okay, so it is an equity. So now the question is, if initially you estimated you would be issuing the shares, but later on you did not. Okay, and if that be the case, what will be the entry for the liability not arising, not crystallizing? Obviously, see, if it were to be equity, if this contingent consideration were to be, for example, equity, if it were to be equity, then there would be no remeasurement here. There would be no remeasurement here, nothing. What would be there was this entry. It would be contingent consideration payable account debit to. Can you transfer it to gain in the P&L? Answer is no, you cannot. Ye equity hai. So you will put it directly under retained earnings. You will put it directly under retained earnings. Yaad karo Ind AS 102. Once upon a time we had studied. Options which are lapsing. Where would you put that? You would put that in retained earnings. Have you understood? Transferred directly to retained earnings. Yes, transferred directly to retained earnings. Okay, good. So that takes care of contingent consideration in totality. Is it fine? Yes. All right. Now we move on to the next concept, that is, ये थोड़ा important है. It's a little, I won't say technical, but little awareness is needed. Okay. Okay. Don't write anything now. Okay, don't write anything. I'll give you in writing, but today, right now, just understand. Okay. Let us assume that we are having L&T's balance sheet in front of us, equity share capital, and then we are having Mindtree's balance sheet also in front of us. Okay. Now, Mindtree's, what you can say, equity share capital. $1,000, and market value of this is $3,000, and you have something like an SBP reserve. You are having something like an SBP reserve. That amount is appearing at 2,000. Okay. This is how the thing is structured. Acha, ye 2,000 kaise aaya? Let us just have a simple case. Mindtree. Grant date fair value. Fair value on grant date 5,000. Vesting period 5 years. Vesting period 5 years. One employee with one option given. ओके तो एक एम्प्लॉय है, एक ही ऑप्शन दिया है, उसका फेयर वैल्यू इज 5,000, वेस्टिंग पीरियड इज 5 years. Okay, so this is how the story is. Now, how am I going to account for this? Well, year 1, year 2. Employee into options per employee. Remember, we used to do this into fair value on grant date 5,000. Total employee benefit expense 5,000 into pro rata 1/5. So this gives you 1,000. EBE till date is earlier recognized. Kuch nahi. This is the first year. So we recognize it at 1,000. We recognize it at 1,000. Expense for current year. Okay. Will I change this fair value in the second period? Answer is no. So 5,000 pro rata 2/5. So this is 2,000. Recognized earlier is 1,000. Expense for current year is 1,000. Expenses for the current year is 1,000. Done. So that is why 1,000 plus 2,000 together coming to 2,000 in your SBP reserve. Are you okay till now? I have not even started business combination. All that I did was I have recorded the share-based payment scheme that is going on. Okay, have you understood so far? Yes, sir. Till now, it's okay. All right, fine. Now, let us understand one or two things. Okay. See, Mindtree's employees. Okay. Employee chhod do. If Mindtree owners were to transfer their shares to L&T, because now L&T is the acquirer, if Mindtree were to transfer its shares to Larsen and Toubro, what do you think Mindtree will accept? What do you think the owners of Mindtree will accept? Yes. Do you think they will accept equity capital of 1,000 appearing in their book? So we will also collect 1,000. Or do you think that we will go ahead with a market-based value? That is, the shareholders will start to expect, you have to give us 3,000 because today the company's worth in the market is 3,000. What do you think? Will they expect 1,000? Will they expect 3,000? आपको क्या लगता है? They will obviously expect market value of 3,000. Yeah, that's right, Sumit Jain, Srishti, that's right. Okay. So park this concept somewhere else. And now let us come to the ESOP plan. Okay, let us now come to the stock option plan. See, this stock option plan has completed 2 years of existence. This stock option plan has completed 2 years of existence. Now, when L&T acquires Mindtree, when Larsen and Toubro acquires Mindtree, at that point of time, do you think, please answer carefully, do you think that employees are owners of Mindtree because उनको ESOP दिया था? Do you think that by virtue of the acquisition that happens, do you think that by virtue of the acquisition that is happening, will the employees of Mindtree become owners of Larsen and Toubro? What do you guys think? By virtue of acquisition, do you think that the employees to whom stock options are given, will they become owners of Larsen and Toubro or not? Srishti is saying no. Any other answer? Any other answer to this question? Just give me a minute. So I have 2-3 people who are saying no, they will not become owners, which is correct. See, unke paas stock option plan of Mindtree is there. They have the stock option plan of Mindtree. How they can become owners of L&T? They cannot. But now coming to the question, because they are owners of Mindtree, do you think L&T has to make the payment to them also? Answer is yes. So what L&T will do is, ultimately it has to bring them also as a shareholder. Ultimately, it has to treat them also as a shareholder and make an offer for a payment. So what L&T will do is, L&T will issue its own stock option. To the employees of Mindtree Limited, which is going to replace the awards that are already existing in the balance sheet of Mindtree. Sir, क्या बोला? फिर से बोलो. Mindtree has stock options which are given to its employees. By virtue of that stock options, the employees of Mindtree become the owners of Mindtree. Since Mindtree is getting acquired by L&T, L&T has to make a payment to all the owners, to all the equity components sitting in the balance sheet of Mindtree. One of that component is these stock option holders. So what L&T will do is, L&T will ultimately issue its own ESOP, and its own ESOP replaces the existing stock options of Mindtree. So what is happening is there is a replacement award that is being issued. There is a replacement award that is being issued. By virtue of this replacement award, what is going to happen is you will ultimately bring the erstwhile employee shareholders of Mindtree in the folds of Larsen and Toubro. Have you understood this part? Did you understand replacement awards? Yes. Accounting kaise karna hai, we'll come to that. Now we are going to that only. But did you understand the concept? Yes. Have you understood this? Yes or no? Not so clear. Okay. All right. Mindtree के books में you are having SBP reserve. Okay. L&T is acquiring Mindtree. In Mindtree's books, there are two owners. One is equity shareholders. You've paid them the cash. So unki taraf se you don't have to worry. The other is employee shareholders. That is, these are the people who are having options. These are the people who are having options. When you are acquiring Mindtree, you obviously cannot ignore these people. Na? You have to pay these people off. You have to pay these people off. Will you pay them cash? Answer is no. मेरे को cash क्यों चाहिए? वो तो employee है ना. So what I am going to do is I will issue a replacement reward. Replacement award, reward, whatever you want to use. Okay. So this replacement award se kya hoga? These employee shareholders of Mindtree will now become employee shareholders of L&T. Have you now understood? Yes. So this is a replacement award that is going to be issued. This is a replacement award. So Srishti, did you follow? Yes. Now, how do I account for it? Now, how do I account for it is the next important question. Okay. Now, suppose year 1, एक काम करते हैं, let us give dates to these years. Okay. The options were granted, original options were granted to the employees of Mindtree by Mindtree on 1st April 2019. So that is 1920, 2021. This is the story. Okay. So ये हो गया मेरा first year, 1920, 2021. Okay. Now, when L&T gives the replacement award, अभी जरा ध्यान से सुनो. Replacement award, I'll keep the conditions same. I'll keep the conditions same. Okay. L&T also will issue a replacement award with a lifespan of 5 years. With a lifespan of 5 years. Okay. Out of these 5 years, lifespan means vesting period is 5 years. Out of these 5 years, L&T will tell, I will consider the fact that you have served for 2 years in Mindtree. I will consider the fact that you have served for 2 years in Mindtree. That means the options will vest only after you serve for a period of just 3 years and not 5 years. So 21, 22, 22, 23, 23, 24. It just matters if you serve these 3 periods. Okay. The date of acquisition for our understanding is 31st March 21. 31st March 21. So the first condition that is placed before the employee shareholders is, I am going to give you options which have a total lifespan of 5 years. But out of the vesting period of 5 years, out of the total vesting period of 5 years, I will consider the fact that you have already served 2 years in Mindtree. So therefore, you are going to serve only the balance 3 years, and then the options of L&T will vest in you. The employees will be agreeable to this condition because उनको ऐसे भी shares immediately नहीं मिलने वाले थे. They would get the shares after a 3-year period. Now also they are going to get the same thing. So it is on a fair basis. It is on a fair basis that the exchange is happening. It is on a fair basis that the exchange is now happening. Let us then move on to the next one. The exchange happens on 31st March 2021. The exchange happens on 31st March 2021. Okay. Now, on 31st March 2021, fair value of option of Mindtree on 31st March 21 is rupees 7,500. Now you now tell me, when L&T comes with a replacement reward to the employees of Mindtree, do you think they will accept 5,000, or do you think they will demand an option whose fair value is 7,500? What do you think they will demand? Do you think they will demand an option with a fair value of 7,500, or do you think they will just sit content and say 5,000 rupees is the options value right now, so we are content with 5,000? What do you think? Srishti is saying 7,500. What about the others? Soham, Nidhi, Sumit. What do you guys think? All of them are saying 7,500, which is absolutely right. That is why I told you, I gave this example in the beginning. Shareholders, book value is 1,000, market value is 3,000. What do you think they will expect? They will expect 3,000 rupees to be paid. Similarly, here also, you are going to expect a payment of 7,500. You are going to expect that the transition will happen at fair value. You are going to expect that the transition from Mindtree's options to L&T's options will happen at fair value of 7,500. So this is what you are going to expect. Okay. So now the terms, L&T agrees to this. L&T agrees to this. It has to agree. There is no option here. Okay. So now look at the conditions. Lifespan of 5 years, out of which 2 have already been served under Mindtree. And second is fair value of the options is 7,500. Fair value of the options is 7,500. Okay. So उस employee के लिए I will give him a one single option, because in our example, one employee with one option of 5,000, he will now relinquish that option and replace it with L&T's option. So L&T's option is worth 7,500. Now think, think. Do you think 7,500 will be purchase consideration? Or do you think 7,500 will not be purchase consideration? Purchase consideration will be something different. What do you think? 7,500 is the fair value of the option which L&T issues to that employee of Mindtree. There is still 3 years vesting period remaining. 2 years have already passed. So what I want you to answer is 7,500 the purchase consideration, or is something else apart from 7,500 the purchase consideration? What do you think? PC equals 7,500 मान सकते हम लोग? Can we assume that the PC is 7,500? Can we assume that the PC is 7,500 or not? Socho, think. I'll give you 1 minute to answer. Sumit is saying no, it cannot. Any other answers? Do you think 7,500 will be the purchase consideration because payment is made by L&T to the employee shareholder in the form of an option? And as we all know, payments can happen other than cash also. So will 7,500 be the purchase consideration is what is my question. Answer is yes. Soham also is saying yes. Okay. Now let us understand how the standard views it. Okay, how the standard views it. See, 7,500 worth of options you have given. Out of this, part is paid because employee is shareholder in Mindtree. Which part this is? This is the 2 by 5 years that he has already spent. This is the 2 by 5 years which he has already spent in Mindtree. Whereas balance part is paid because employee will render services in next 3 years. In next 3 years. Look at the terms. I told you it will be exactly the same terms as Mindtree. तो 5 साल का ऑप्शन दिया था, 2 साल जो Mindtree में सर्व किया, that's already considered. You have to serve additional 7,500. And now I want you to tell me, so 3 by 5. Is this 3 by 5, this portion, on account of the employee being a shareholder, or is it on account of expectation that the employee will serve for the next 3 years and then be eligible to exercise this option? What do you think? This 3 by 5, what does it represent? Does it represent the fact that the employee is a shareholder, for which reason this 3 by 5 is considered? Or does it represent the fact that the employee will remain in the organization, continue to serve for the next 3 years, and therefore you are making this payment? So Srishti is saying it's based on the expectation. In other words, can I say that this option, 3/5 of this portion, is going to go to the employee in the capacity of an employee? It is going to go to the employee in the capacity of an employee. Whereas the first 2 years, which you said we will consider what you have served, the first 2 years, which is already served, this will be in the capacity of a shareholder. This will be in the capacity of a shareholder. Whereas this will be in capacity of an employee. क्योंकि आप क्या कह रहे हो? You have to serve for the next 3 years, only then you will be entitled to exercise this option. Only then you will be entitled to exercise this option. So therefore, a single option that is replacing the existing option worth 5,000. A single option worth 7,500. The fair value of the option on the date of acquisition is replacing that option. Out of that, 2/5 is purely in the capacity of shareholder because services are already provided up to the date of acquisition. So this is purely in the capacity of shareholder, this 2/5. The remaining 3/5 is nothing but the period that the employee will have to serve in order to be eligible to, it is the period that the employee will serve the organization in order to be eligible to exercise this option. So this becomes a service condition, not a shareholder related condition. This becomes a service condition. This is not a shareholder related condition. Have you understood this? Yes. So therefore 7,500 into 2 by 5, if I do that, this comes to rupees 3,000 and this comes to rupees 4,500. This comes to 4,500. What do I do with 3,000? This will go as a part of purchase consideration. This will go as a part of purchase consideration. What do I do with this 4,500? Over the next 3 years, you write it off on a straight line basis. You write it off on a straight line basis. Is it okay? Yes. Is it fine? Yes. Srishti. Sumit, आपको समझा? Sumit, आपको समझा? Soham, did you follow? Yes. Sumit को समझा, Soham has confirmed. Nidhi, did you follow? Yes. Okay. तो ये हो गया मेरा basic understanding. This is my basic understanding of replacement rewards. So what you are going to do is, on the date of acquisition, identify the fair value of the options of the target company, allocate it based on the pre-combination and post-combination period. And then you will later on start to give the effects. Items in the pre-combination period, amount in the pre-combination period will form a part of purchase consideration. Amounts in the post-acquisition period. In the post-acquisition period, it will be treated as employee services expected to be rendered over the period. Is it okay? Yes, all clear? Any doubts? So part of it goes to PC, part of it would be taken as employee benefit expenses. It will be recorded, 4,500 will be recorded like a normal stock option plan. Employee benefit expense to SBP reserve, 1,500, 1,500, 1,500 each year. Okay. Is it fine? All right, all clear. Good. Now. Okay, now let us start to modify this. Suppose these options were granted in I'll slightly start to change the questions now because you have all understood the concept. Okay. So suppose these options were granted on 1st April 2016. 2016-17. Okay. So what I want you to tell me, rest all conditions are the same. Value is 7,500 on 31st March 21. vesting period is 5 years. All the things are the same. Okay. So now what I want you to tell me is, will there be any change in this working? Will there be any change in this working? Everything is same. Fair value is 7,500. Will there be any change in this working? If yes, what will be the change? If yes, what will be the change? Sir, options would have been vested till the date of acquisition. Options will be vested. So yeah, ratio will change. That means how many years have I completed? 16, 17, 17, 18, 18, 19, 19, 20, 20, 21. मैंने already 5 साल खत्म कर दिया है. I have already completed 5 years. So here it will be nil. Here it will be nil. 4/5 नहीं होगा ना. 16, 17, 17, 18, 18, 19, 19, 20, 20, 21. 5 years are over. Immediately on completion of the 5th year, you are having your immediately on completion of the 5th year, you are having the acquisition taking place. So in other words, the entire amount of 7,500 would go as a part of PC, would go as a part of PC. So will I have anything that will be taken to the next period in the form of employee benefit expense? Answer is no. There is nothing else. There is nothing that will be left. Entire 7,500 will go and sit as purchase consideration. Have you understood? Yes. अरे अपने को समझा क्या? Did you understand? Soham, did you follow? Yes. Nidhi followed. Srishti followed. Kaushiki is not there today. Okay. Yes. All right. Fine. So now let us move on to the next twist. Let us move on to the next twist. Okay. Now L&T will tell, see, I am acquiring Mindtree. एक तो मैंने चोरी छुपे Mindtree को acquire किया. I have acquired Mindtree in a hostile manner. तो मेरे को मालूम नहीं whether employees will take my acquisition in a happy note or will they be acrimonious towards me. So L&T क्या बोलता है? See, इसमें ना there is no need to what you can say, there is no need to do miserly treatment. उनको जो चाहिए हम थोड़ा सा ज्यादा देंगे. We will pay something more. Okay, fair enough. So now the fair value of the options of Mindtree on the date of acquisition is 7,500. Is 7,500. L&T बोलता है, देख, I am going to issue you one option, but उस option का value will not be 7,500. The value of that option I will give rupees 8,700. I will be issuing an option that has a fair value of 8,700 and not 7,500. Is it okay? Yes. Yes. All right. So fair value of option of Mindtree, though it is 7,500, what the employee is going to get is an option with a fair value of 8,700. Now you think and tell me. Now you think and tell me. The additional amount that is paid, 7,500 to 8,700, that extra 1,200 which is paid, is it on account of purchase consideration or is it on account of something else? Is it on account of something else? See, on the date of acquisition, fair value is 7,500. Usme there is no change in the facts. Okay. But this extra amount that is being paid, is it on account of payment made to employee shareholders, or is it something else? Sumit Jain is saying it is PC. Is it something else? आप fair value से ज्यादा दे रहे हो. Fair value is 7,500. Why are you paying 8,700? देखो, when I discussed PC yesterday, I was telling fair value. घूम फिर के fair value पे ही बात होती थी. So your purchase consideration component continues to remain at 7,500 into 2 by 5. Continues to remain at 7,500 into 2 by 5 is equal to, this gives you how much? 3,000. But sir, L&T gave an option with fair value of 8,700 and you have always told us that payment made to shareholders will be regarded as PC. Why are you not considering 8,700? 8,700 एक तो वो fair value नहीं है. So that is why it cannot be a part of PC. Second, generally when you give something extra, it's not because you are large-hearted and generous by nature. Okay, it is because in this case you are paying them so that they serve you diligently. Okay, see, you have entered into a hostile takeover. The employees may not be very open with you, so you want them to be very open. You want them to minimize the attrition rate. You want to ensure your organization grows, and that is why the differential amount of 1,200 that is paid, it is not the fair value on the date of acquisition, and therefore we cannot consider that in any by any stretch of imagination as a part of PC. It is more like you are incentivizing the employee कि आओ हमारे साथ काम करो, we are paying you something extra. That something extra is because of the fact that you are inducing him, you are incentivizing him not to leave the organization because acquisition has happened. You will be treating it as an employee benefit cost. So how am I going to do that? Well, 8,700 minus 7,000 minus 3,000. So you are left with how much? 8 minus 3, 5,700. 1,900 per year would be expensed out. 1,900 per year would be expensed out. Earlier, kitna tha mera? This was 4,500. So what I told, 4,500 by 3, 1,500 per year. 1,500 per year is what you would have taken as employee benefit expense. That 1,500 has become 1,900 per year. So 400 into 3, 1,200 will be written off here. Is it okay? Yes, it's not for goodwill. It is an incentive that you are giving to the employees of Mindtree to stay and serve the organization. Is it okay? Have you understood? 8,700 minus 3,000 gives you 5,700. सुमित समझा आपको? सोहम, did you follow? Nidhi, did you follow? Yes. I'll give you in writing. Okay, don't worry. Got it. Okay, fine. Fine, fine, fine. All right. Now, okay. So, for our calculation of PC, we will be considering the fair value of the option on the date of acquisition, number one, and any differential amount is going to go as employee benefit expense, which will be amortized on a straight line basis over the what you can say, the remaining useful life, the remaining vesting period of the option. Okay, now let us move ahead. Okay, suppose, abhi zara dhyan dena. Okay, please pay attention. Suppose I had these options in issue right since 1st April 2016. Right since 1st April 2016. Okay. Now, L&T came out with these options. L&T came out with these options of 7,500 with 6-year vesting period. With 6-year vesting period. Okay. With a 6-year vesting period. Out of these 6 years, 5 years is already met. 5 years is already met. Please remember, in Mindtree's books also, the option had a what you can say 5-year vesting period. Okay. It had a 5-year vesting period then. Now it is coming with a 6-year vesting period. So what you will do, fatafat, you will take your calculators, 7,500 into 5 by 5 because 5-year is your vesting period. So 5 divided by 5. So that comes to 7,500. Okay. Now the question is, can I say that the option has a 6-year vesting period? The initial option had a 5-year vesting period. So I have adjusted the PC entirely based on 5 by 5. Okay. Will there be something left for employee benefits to write off as an expense? In this case, answer is no. Nothing will be left. However, in the case of a 6-year vesting period, don't you think that the employee must serve for an additional period of 1 year? Don't you think that the employee will serve for at least 1 period, 1 year. What do you think? It is a 6-year lifespan. 5 साल जो आपने वहां सर्व किया, it's already considered. Don't you think 1 year का खर्चा आना चाहिए? Yes. Don't you think 1 year's expense should come as part of employee benefit expense? Yes or no? This will be lifespan of 6 years. Yes, sir. If he has to serve 1 year, कुछ खर्चे का amount बचना चाहिए ना. There has to be some amount that is left. He cannot just say that I will write off 5 by 5 year because initial option had a lifespan of 5 years on account of vesting. So 5 that and 5 is already completed. We will take it as 5 by 5. Can you say that? Answer is no, you cannot say like that. What you will have to say is, see, the fresh option now has a lifespan of 6 years. So I will take it as 7,500 divided by 6 multiplied by 5. Okay, 7,500 divided by 6 multiplied by 5. So that comes to how much? 7,500 divided by 6. How much does that come to? 6,250. So out of the replacement reward of 7,500, 6,250 will form a part of PC. The remaining 1,250 will be taken as an expense. The remaining 1,250 will be taken as an expense. You will not take straight away 5 by 5. You will make it as 5 by 6. Otherwise, these kind of mistakes, these kind of anomalies, you will be having in your answer. Is it okay? Yes. Any doubts? So therefore, it will be 7,500 into whatever period of vesting is serviced. Okay. Vesting period serviced divided by longer of original period or total revised period. It will be longer of original period or total revised vesting period. Have you understood this? Have you understood this? Yes. So 6,250 will be PC, 1,250 will be employee benefit expenses. Sir, in the earlier two scenarios, there will be a PC component. Yes, but still the option is not vested. It won't, because the employee is to provide service to you. So will this PC be a contingent consideration? No. This PC will be a contingent consideration? No, because you've already paid on the date of acquisition. You've already considered the fact that he has served 2 years in the acquiree, and therefore you will not say that this will be a contingent consideration. Okay, all right. Srishti, sir, accounting till 5 years done will change accordingly. Answer is no, it is not going to change. See, what Mindtree has done in its books is perfectly fine. Yeah, Mindtree gave the option of 5 years. It has done the accounting in 5 years. Mindtree is totally fine with its accounting. The problem arises on account of acquisition by L&T. Okay, so that is not going to be restated or not going to be remeasured. Okay, it will be, this will be adjusted only. That's it, nothing else. Is it okay? Yes. Have you guys understood? Have you guys understood? Yes. We will pay these employees with the normal shareholders only. Yes. But only thing is you are going to pay them in the form of replacement awards. You are going to pay them in the form of replacement awards. Is it okay? Yes. Have you guys understood? Now fully clear. Srishti is saying it is clear. Kaushiki, 400 in the original case, what was the monthly cost? That will go to SBP reserve only. Debit will of course be charged to the P&L. Debit will go as employee benefit expense charged to the P&L. Have you guys understood completely? Yes. Okay. All right. So give the heading note 4. I think you may have given the heading already. Yes, replacement awards. You can write in bracket here SBPs at time of business combinations. Okay, so now we'll draw the chart and that should take care of your understanding. Okay, so we start up with fair value of replacement award. This is that 7,500 that we had. This is that 7,500 that we had. Okay. Pre-combination allocation. This is in line with Ind AS 103. Post-combination allocation. That 3 by 5 which we saw initially. Okay. This is in line with Ind AS 102. That is share-based payments. Okay. Now here allocation to be part of purchase consideration as it is paid to the employees in the capacity of being owners in the selling company. So the entry here will be net assets of S debit to equity shares or cash to SBP reserve. So this gives rise to goodwill. This is the entry that you will pass and you will add fair value of replacement awards. Is it okay? Have you noted this part? In this case, allocation would be a balancing figure. That is, how would I calculate it? Fair value of replacement award minus pre-combination allocation. Pre-combination allocation. It won't cause any difference. That is what I told you. 8,700 minus 7,500, 1,200 over the next 3 years. You are paying 400, 400, 400 extra. So why are you paying that 400? You are incentivizing the employee to say, tell him that, look, I'm giving you something extra. मेरे पास आके तुम्हें काम करना चाहिए. You have to work here. You have to work here. Okay. So therefore, that amount will also be part of my employee benefit expense on the debit, and credit will obviously be SBP reserve. Will obviously be SBP reserve. Okay. I got your question that time only. I hope you are satisfied with the answer. Sir, but we are issuing shares. You are not issuing shares. That is the. What are you giving, Soham? We are giving a replacement award. We are not giving them shares. अरे why will I give them shares? वो खुद तो पूरे तरीके से shareholder नहीं है अभी तक. They are still not shareholders in the complete sense. They still have a vesting period to complete. They still have a service condition to fulfill. तो ये सब चीजें जब रहेंगे, how can I give them the shares? What I am also issuing to them is an award. That is what I am issuing to them is also a stock option only, not a complete share. Uske conditions hai before it can become a share. Is it okay? Yes. Kaushiki, are you clear on that 400? Yes. All right. And then what do I do with this figure? Recorded as remuneration cost or employee benefit expense. Transferred to P&L over the remaining vesting period. Over the remaining vesting period. Attributable to service rendered by employee over post acquisition period. Over post acquisition period. So here, what is the entry that you will pass? EBE debit to SBP reserve. EBE, okay, to SBP reserve. Kaushiki, did you understand better? See, replacement award, what you are doing is you are issuing another stock option to replace the existing stock option. You are not issuing shares, so I cannot credit equity share capital. Done? Done? What I'll do is we will solve a couple of questions after a small break, 1 or 2 questions, and then clear it. Srishti, did you follow? Nidhi, did you follow? Kaushiki, did you follow? Sumit, समझा आपको? All right. So pre-combination allocation is calculated like this. Pre-combination allocation, fair value of original award on acquisition date multiplied by vesting period served. We saw that 2 years in our example, divided by longer of original vesting period or total revised vesting period. Total revised vesting period. Okay. So that takes care of pre-combination allocation. Pre-combination allocation. Sumit, did you follow? Okay, done. Have you guys noted this? Okay, all right. So that takes care of note 4. Come back to the place where you left half a page for the PC. Add fair value of pre-combination allocation in case of replacement okay, done. Okay, done. So we take a 5-minute break. and then we shall continue. We'll try to do some questions. Okay. Take a 5-minute break and continue at 9:06. It's 9:01 right now. Okay. Okay. All right. So welcome back. Uh, as such, again, as I was telling you, we don't have individual concept-based questions. So we'll see if I can search for some question on replacement rewards exclusively. Otherwise, we will have to proceed to the next concept. Green limited. Yep. There is one question. Green limited. 1 second. Give me a minute, please. I'll just search for that question. Employee shareholders. Yep. Okay. All right. So this is a question from your study module. Green Limited acquired Pollution Limited as a part of the arrangement. As a part of the arrangement, Green Limited had to replace Polluted Limited's existing equity settled award. The original award specify a vesting period of 5 years. At the acquisition date, Pollution Limited already have rendered 2 years of service. Okay. As required, Green Limited replaced the original awards with its own share-based payment awards. Okay. The vesting period is reduced to 2 years from the acquisition date. The value, a market-based measure of the awards at the acquisition date, are as follows. Original awards is 500, replacement awards is 600. These are the fair values. As of the acquisition date, all the awards are expected to vest. So replacement award has a value of 600. That means we will take 600 and then do the allocation. However, when we do the allocation to the pre-combination period, we will take 500. That is the fair value of the original awards and allocate it. And whatever is the balancing figure, we will allocate it to the post-combination period. Okay, so just quickly we shall solve that one illustration. So things will be clearer for us. Okay. So illustration 27. One is fair value of replacement award is 600. Fair value of replacement award is equal to rupees 600. Now this we will be splitting it between pre-combination allocation and post-combination allocation. Okay. Fair value of the original awards is 500. So we will do the allocation based on this. So this is fair value of original award multiplied by vesting period served divided by longer of original vesting period or total revised vesting period. So this is equal to 500 into 2 years are already served. See, original vesting period was 5 years. Original 5. New rewards, the vesting period is reduced to 2 years from the acquisition date. So see, they had already served 2 years as at the acquisition date. So original was 5 years, revised is 2 plus 2. that is equal to 4. So longer of the two means 5 years. So we will do the allocation based on 5 years. So this comes to 200. This comes to 200. Post combination allocation is equal to fair value of replacement rewards minus pre-combination allocation. Pre-combination allocation. So this is 600 minus 200. So this is 400. What am I going to do with this 200? Treat as part of PC on the date of acquisition. Whereas in this case, what are you going to do? Treat as remuneration cost. Remuneration cost, basically employee benefit expense over remaining vesting period of 2 years. Over remaining vesting period of 2 years. Is it okay? Yes. So every year 200 will be taken for 2 years as employee benefit expenses. As employee benefit expenses. Is it okay? Have you guys understood? Yeah. Any doubts? What is 2-2? See, the revised replacement award has a lifespan of 2 years from the date of acquisition. That is why 2-2. Okay, I hope that is only what you are meaning 2-2. Okay. If I have to draw a timeline, this is date of acquisition. So, second. Date of acquisition. So, original award, 2 years was completed up to the date of acquisition, and you had 3 years after the date of acquisition. Okay. Now, revised or replacement award. What is it saying? This will be a 2-year period that they have given. Okay, they have said that the award will vest in 2 years. So that is why we have taken this 2-year period here. Okay, we have taken, and this 2 years is nothing but this 2. Okay, this 2 years is 2. Okay. And here 2 years are already completed. So this total duration of the award here is 4 years. And here it is 5 years. So therefore, I am allocating based on 5 years in the pre-acquisition period. But in the post-acquisition period, the award will remain as vesting only for a period of 2 years. So this takes a period of 2 years. Okay. Award means, yeah, you can take it as a kind of a compensation, no? So when we say replacement awards, it is like replacement stock options which are being given. Even the original stock option plans, you could say that they are rewards given to employees for the services that they are providing. Okay, so that takes care of note number 4 or 5. It was note number 4, I think. That is that is replacement rewards. Okay, so now what I want you to do is see, there is this particular question. I need you to try this question 30, which is a test your knowledge question. Question number 10. I hope I got the question numbers right. Yes. So I want you to try this for homework. It is fairly simple. It is fairly simple. I will tell you what it is. How should contingent consideration payable be recognized in the following cases? 1st April, A acquires 100% interest in B, paid in the following 2 tranches. Immediate issuance of 10 lakh shares of A having face value of 10 per share. This is face value. Okay. So is this a deferred consideration or contingent? No, this is a normal consideration. ये सीधा सीधा जाएगा आपके PC में, but at fair value. Further issuance of 2 lakhs after 1 year if the profit for the first year following acquisition exceeds 1 crore. So this becomes contingent consideration. Fair value of shares of A Limited on the date of acquisition is 20 per share. Further, management has estimated that on the date of acquisition, fair value of contingent consideration is 25 lakhs. So this straight away will go to the PC. This is fair value on date of acquisition. During the year ended 31st March 20x2, profit before interest and tax exceeded rupees 1 crore. So as on 31st March, the fair value of shares of A Limited is 25 rupees per share. So straightforward, nothing new. Continuing with the fact pattern in A above, except for the fact that number of shares to be issued after 1 year is not fixed. So in this case, rather A agreed to issue variable number of shares having a fair value equal to 40 lakhs after 1 year if the profit before interest and tax for the first year exceeds rupees 1 crore. A issued shares with rupees 40 lakhs after a year. So first case, it was fixed. Contingent, what will be the contingent consideration, what will be the payment, all of that was fixed. So it was regarded as contingent consideration equity. In the second scenario, it is regarded as a liability because of the fact that the number of shares are not fixed, it is variable. Okay, so that is how you would do the recording. Okay, that is how you would treat it. Okay, and accordingly you will compute the shares and calculate. So I want you guys to try this question for homework. It is on contingent consideration. Okay, all right, next. This is done. Okay. Oof. Okay, so now coming to note 5. Existing investment before control is acquired. Before control is acquired. Okay. We also call this as step up acquisition. We also call this as step up acquisition. Okay. So now, what do you mean by step up acquisition? Okay. So it goes something like this. Let us assume that P acquires shares in S as under 1st April 2019. 20% shares were acquired at a cost of rupees 2 lakhs. Okay, at cost. See, typically, if you reach 20%, you can be regarded as an associate. Okay, that is what is the general understanding. When you do Ind AS 28, that time you will look at it in more detail. It is at cost, not at fair value, because it is an associate. So that exception is given in Ind AS 27. Okay, 1/4/2021, remaining 80% acquired for rupees 16 lakhs. Okay. So now tell me, when do you think control will be acquired? Will it be acquired on 1st April 19 or will it be acquired on 1st April 21? Obviously, it will be acquired on 1st April 2021. It is going to be acquired on 1st April 2021 when you acquire the remaining 80%. Okay. So let us assume that on 1st April 21, net assets of S is equal to 15 lakhs, and fair value of 20% stake is rupees 4 lakhs, Okay. 1st April 21, net assets of S is 15 lakhs. Fair value of 20% stake is 4 lakhs. So now Ind AS will apply, 103 will apply on 1st April 21 because there is clear-cut acquisition of control on that date. So now net assets taken over is 15 lakhs. Okay. And see, this is a case where I'm acquiring shares in an entity. After this acquisition, will S Limited liquidate? Answer is no. It will also continue to exist. So it looks something like this. Please pay attention because I have to read the journal entries out to you. So you have to first understand the concept. Okay. Now see. On 1st April 2021, if I pass this entry, net assets account debit, I'm acquiring the company. To bank, this is the PC. मैंने कितना पे किया? 16 lakhs. So I am having a goodwill of 1 lakh. Do you think this entry is correct? Because I have taken the acquisition. So tell me, is this entry correct or is there any change that needs to be done in this case? We have to take impact of existing investment. Absolutely. See, I am recording 100% of net assets, but only 80% of investment, but only 80% of my shares. Whereas in fact, I do hold 100% shares. So when I take 180%, it's not making sense to me because it's entirely, I am entirely the owner, and therefore that 20% should also form a part of this acquisition. So now, oh, I think you guys already know this. I'm getting the answers. So what you are going to do is you will have to investment in S, existing investment. Okay. So that comes to how much? Should it come at 2 lakhs? If I take it at 2 lakhs, 16 plus 2, 18 minus 15, 3 lakhs. So now you tell me, is this entry correct? Is this entry correct? ये 80% है, This is 20%. That is 100%. Okay. Just answering by logic. All right. Fine. I'll explain the concept also. Okay. So Srishti is saying this entry looks correct, sir. Apparently, there is no problem. What about the others? Do you think this entry is right? Do you think this entry makes sense? Okay. Do you think this entry makes sense? Okay. Kaushiki is saying investment in S should be at fair value. Okay. Any other answers? Sumit is saying entry ठीक लग रहा है. What about the others? Any other answer? It's okay. All right. Let me understand the story right now. See, this net assets is fair value on 1st April 21. Okay. This 16 lakhs is fair value on 1st April 21. This 2 lakhs is fair value. You would have paid the fair value only on 1st April 2019. So ultimately, ये जो goodwill बन रहा है of 3 lakhs, the goodwill that is being formed, don't you think यहाँ पे तो खिचड़ी पक रही है? Because it is having some impacts of 1st April 21 and it is having some figure of 1st April 2019. Are, when are you effective? I told you, whenever we have to understand a particular question, we have to think from the perspective कि भाई ये standard का reason क्या? What was the reason for having this standard? The reason is to ensure my goodwill is as fair as it can be. So it can be as fair only if all the dates match on 1st April 2021 in this example. That point of time, I can say that goodwill of 3 lakh is rupees, is goodwill is so much on 1st April 21. In this case, 3 lakhs is not exclusively a 1st April 21 value. It is a mixture of net assets and PC of 80% at fair values of 1st April 21, whereas 20% stake is based on the value on 1st April 2019. So that is not correct. That is not correct. So therefore, this one has to change. This should change to the fair value. This should change to the fair value of 4 lakhs. And if this changes to the fair value of 4 lakhs, my goodwill will become 5 lakhs. And now all these are at 1st April 21, 1st April 21. So therefore, goodwill also is going to come on 1st April 2021. Goodwill also will come at 1st April 2000. And have I taken the right figures? 16 plus 4, 20. Yes. Yes. So this is also going to come at 5 lakhs. Yes. All right. So now the problem is an accounting one. Sir, abhi fir se dekho, investment in S is a debit of 2 lakhs. We are crediting investment in S with 4 lakhs. So investment in S ledger ends up becoming negative. So we've already studied na. अगर नेगेटिव होता है तो डू अ फेयर वैल्यूएशन, टेक द गैप टू योर P&L. So first you will do a fair valuation of the investment. So entry will be investment account debit to P&L. That will go to 2 lakhs and then you pass the entry for 4 lakhs. So the first entry that you will pass is investment in S debit to P&L. This is 2 lakhs. So this becomes 4 lakhs after this entry. And then you pass that entry, investment in S will not become negative. Investment in S will not become negative. Okay. This is going to be done if and only if your equity instruments are appearing at cost. Generally, they don't, except in 3 cases. If it is investment in subsidiary, associate, joint ventures. Any other investment, it would be appearing at fair value through P&L or fair value through other comprehensive income. So it would already be fair value. तो अपने को फिर से fair value करने की जरूरत नहीं है. There is no need to fair value it again. Take that value and then do the adjusting impact on account of accounting. Okay. So that is how you can do it. Okay, so this is one way of understanding. Now moving on to the next part. Sir, I am crediting investment. So does it mean am I selling off this investment? See, you have always studied one thing, that this becomes which type of account? Personal, nominal, real. This is a real account. Credit what goes out. So investment is credited. So does it mean investment of 20% is being sold in this case? Does it mean investment of 20% is being sold out in this case? What do you guys think? Yes, it's a bit stretched. Can't help it. I have to do it this way so that you guys can understand. Okay. All right. Tell me, do you think investment is being sold here? The 20% stake which I am having, is it getting sold here? Removal of own equity. Kaise, how? Which is why let us introduce you to the concept of consolidation. Which is why let us introduce you to the concept of consolidation. Okay. P Limited acquires 80% stake of S Limited. Earlier it had 20% say. Earlier it had a 20% stake. So now when I have to consolidate S Limited into P Limited, what do you mean by consolidation? What do you mean by consolidation? It is P and S presented together as one single entity. Presented together as one single entity. So in P Limited's balance sheet, you would be having investment in S appearing at a particular value. Okay. Forget 80, 20, etc. Everything. Okay. In the case of S, you would be having equity share capital. Okay. Of a particular value. Now, this investment in S is a representative of the net worth of S. Yes or no? Each equity share is a representative of net worth of the subsidiary. So therefore, this investment, when I start to consolidate, I will end up removing this investment in S and replacing it with what? I will replace it with assets of S. I will replace it with liabilities of S. I will also consider the reserves of S. So basically, investment, all assets, all liabilities, all of them will get added to that of P. And what gets eliminated is the investment in S. In the case of S, the equity share capital gets eliminated against this investment because it becomes something like an intercompany transaction. It becomes something like an intercompany transaction. At the same time, it would be having certain reserves. These reserves would also form a part of the consolidated balance sheet of P in different ways. Okay. That means something would be replaced with we will compute something known as pre-acquisition profits, post-acquisition profits, and then post-acquisition profits of S will be added to the reserves of P. Pre-acquisition profits would be adjusted against investment in S. All of that we will look at when we look at Ind AS 110. But basically what I want to tell you is that investment in S will vanish away in the consolidated financial statements, and that gets replaced by assets, liabilities, and profits of S. So that is how you will understand consolidation. So that is the reason why investment is getting credited here. The investment getting credited here is not in the standalone books, mind you. This entry will never be passed in standalone. ये जो एंट्री है, this entry is not going to come in the standalone books. आप P Limited's financial accounts you open and see, what are you going to view is investment in S 2 lakhs, investment in S 16 lakhs. That's it. You are going to view this as investment in S of 18 lakhs. That's it. All these adjustments are going to be passed only in the consolidated books. These are certain adjustment entries. Consolidated books essentially means certain consolidation adjustments जिसका impact हम लोग दे देंगे, जिसका impact हम लोग consolidation के time पे देंगे. So this is not in standalone books. So don't ever say that, sir, we are selling this investment. No, we are not selling. We are eliminating the investment in the consolidated books so that the investment can be replaced by assets, liabilities, and incomes and expenses of the subsidiary. Okay, so that is what is the meaning of crediting the investment in S. Okay, and also as one student said, it is going to be a part of my intercompany eliminations. Yes, it is a form of intercompany elimination. So investment in S and equity share capital, they cross cancel out each other because my investment in S is S's own equity share capital. So we ultimately end up canceling that out. There is another perspective to this. Okay, Deloitte came out with a publication wherein it has put something, it has introduced a concept known as accounting boundaries. It has introduced a concept known as accounting boundaries. This is a way of perspective. This is a way of perspective. Okay. See, initially, P Limited had a 20% stake. Had a 20% stake. Is taraf jayenge of the boundary, there is no control. Okay. What Deloitte tells us is, in its publication, it has split the ownership stake into two categories, 20%, 50%. Below 20%, there is no control. No significant influence also. No significant influence also. More than 20, less than 50, you will be having a significant influence. Significant influence means what? You will get a position on the board of directors because you're holding at least 1/5 of the stake. And above 50% jo hoga, this is going to result in control. This is going to result in control. So when you cross the accounting boundaries, there will be a fundamental change in perception of your investment. So in the given case, P Limited moved straight away from 20% to 100%. It has moved straight away from 20 to 100. So this is going to be a change in perception. So what is the interpretation of the IFRS? That is the International Accounting Standards Board is, they are going to treat it technically. I mean, if I have to use the words substance over form, they are going to treat it as disposal of 20% and acquisition of 100% stake. This is what they call as substance over form. This is what they call as substance over form, which is exactly what it appears. I am disposing of 20% and also recording a profit of 2 lakhs thereon on account of remeasurement. So this is the substance. Substance is, it appears I am disposing of 20% and I am replacing it with 100% of the net assets of the parent company, of the subsidiary. So give up 20, acquire 80. But in reality, how is the transaction happening? In reality, I already have 20. I'm only purchasing additional 80%. So you can take it as either of the understandings. First understanding, I'm crossing an accounting boundary. It is a change in my investment nature. So therefore, substance over form demands that treat it as a disposal of existing stake and acquisition of the new stake in entirety. That is the first way of interpretation. Second way of interpretation is what we explained just now. Consolidation books, investment will go away and be replaced by net assets of S. जो आपको comfortable लगे, you can assume that we will primarily be following in India, I mean in your curriculum, we will primarily be following this concept. Okay, I will not be addressing much on this concept because ultimately एक तो picture is the same. There is no change in the picture. There is no change in the impact. Only thing is this understanding for us is more clearer than this understanding. That's it. Okay, because here disposal kahan ho raha hai, where is the sale happening, we have to answer all those questions every now and then. So that is why this second interpretation appears confusing. So we move on to the first interpretation only. Okay, so this means even if there is a business combination by purchase of shares, we have to see for the goodwill or capital reserve, but only, yes, obviously, definitely. So ultimately, business combination leads to consolidation in the future when you are acquiring a stake in a company. Okay, so it ultimately leads to a consolidation in future. So this is your last important part, that is note number 5, that deals with PC. Okay, we still have step number 4, net assets. We still have step number 5, NCI, and we have the goodwill. So all these 3 steps we should be completing in our next session on Saturday. We will write a small note on investment before control is acquired in your Saturday's class itself. Okay, we will write it in your Saturday's class, and then we'll see a couple of things before we move on to sessions, topics like reverse acquisition, etc., etc. Okay, so this takes care of our class for today. I hope it was something different. I think we spent a lot of time on replacement awards. I hope that it is clear to you. That is a favorite that will be asked in your examinations. Okay, so with that, let us conclude our session for today, and see you guys on Saturday morning. Okay, see you guys on Saturday, and that's it. So take care, everyone. Anybody has any doubts? Kaushiki, Srishti, Sumit, uh, Nidhi Deshpande, if you are there, do you have any doubts? No doubts. No doubts. No doubts means either you have not understood at all or you have understood fully. Okay. All right, fine. Thank you. So see you guys on Saturday. Okay. Thank you. Nisarg, we can end the session. Nisarg?